So I deleted all my hedge videos along with my old channel, and I don't keep them. I have to constantly delete them because they're so big on the hard drive, and I don't know why I don't keep them. But anyway, I don't have them any longer. But some people are asking for me to go over it again, so I'm fixing to go over real quick what I've done start to finish. Okay, so I first started out with this hedge. It was the October 2011 $30 puts. And what this did is it ensured that I keep all my gains up to 30 till October. So I was never going to go under 30. And, you know, the last amount I bought was 27, so I was just protecting all the gains of my own money. And it cost me 70 cents an ounce to do this, right? And here's where this hedge is today. It's up 54%, right? But that would only keep my gains up to 30. So on Friday, and I made a video, I took it down because I told how many contracts I bought, which I don't want people to know what my positions are, so I took it down. But anyway, I'm going to explain to you what I did on Friday. I did make a video on this. On Friday, I moved my hedge to ZSL calls because ZSL is double short silver, and it goes up twice as much as silver goes down. So like ZSL was up 17% today, and silver was down 9%. So, and it cost me a little bit more to do this, but I only had to buy half as much. And I ended up actually buying more than half my position for the same price as my SLV hedge. So I sold my SLV hedge for the exact same as I bought it. It was a wash, you know, minus the transaction fee. But it was basically a wash. And then I rolled them over into ZSL hedge. And this is why I did that. So I bought on ZSL, let me find it here. I bought this one, and I paid $1.20 for it. Okay, so while it cost me, you know, the SLV hedge was 70 cents. This was $1.20. I only had to buy half as much because it's double performance, right? So if you had 1,000 ounces of silver, you only had to buy 500 of these options or 5 contracts because it's double performance. Well, I actually went above and beyond that. I bought like 65% of my position instead of 50. So, you know, I even have more protection. And this also covered all my gains up to 37 instead of 30 for less cost than my SLV hedge. That's why I moved it into this, because it made more sense. Because it's double performance, it costs less than the other one. I could cover more than the other one at a higher price, 37. So let me tell you what I'm saying. So this is a November 2011 $23 call. So this protects all my gains up to ZSL being at 23, right? So let's look at the chart here. This is ZSL. Last time it was 23 was April 1st. Okay? Well, let's look at SLV on April 1st. It was $36.86 or $37. So it protects me at $37. I lock my gains in at $37. And for every dollar it goes down under $37, I make $2 on my hedge because it goes up twice as much. So the hedge today was up, let me find the right one. 66% from $1.35. I got it at $1.20. Okay, so it's up about 70% today. And ZSL is trading at about 16 bucks right now, 17 bucks. So it's still a little bit far away from 23. And so I'm not making my gains up dollar for dollar until it hits 23, which is about $37 silver. But from then on, I'll make it up twice for every dollar it goes down. Now, I only own about 65% of my position, so it's not quite, you know, double, but it's more than 100%. I'm going to get paid more than 100% on every loss under $37. And I did this out in November 2011, so I want to make sure I locked as cheaply as possible, I locked in my gains at 37. So, but also, since this is way out in the future, if it hit 20, if ZSL hit 23 tomorrow, this would be worth $5 or $6 per ounce, right? And if silver went down to 25, ZSL would be worth 60. So what I paid $1.20 for would be worth $60. And I could sell that and go buy cheap physical on the market. So, I mean, this is kind of complicated for people to understand it, but basically, ZSL is a ETF that tracks double the inverse performance of silver. So if silver goes up 1%, ZSL goes down 2%. If silver, if SLV or silver goes down 1%, it goes up 2%. So for example, silver is down around 9% today, and ZSL was up almost 18%. So it was up twice as much as silver was down. Right? That's why you only have to cover half your ounces with the contracts, because it's double the performance. And since I could, I just took the amount of money from selling my hedge in SLV, which is basically I got exactly what I paid for it. But I took that same amount of money and I covered as much as I could with it in ZSL, and I got about 65% at $37. So it makes sure that I'm never going to be under $37. And if it, since it's way out in the future, it didn't even have to get to 37 before I start making dollar for dollar, or more than that, because I got 65% of my position instead of 50. So anyway, I pretty much locked my gains in around 40. I mean, it's not going to really start paying off huge until ZSL hits 23, which is $37 silver. But at that point, I'll be making up, if it keeps going down, I'll be making up more than the losses, right? And that's just cash that gets bigger and bigger and bigger. And at some point, when I think silver is a bargain again, I'll cash out that hedge and I'll just blow it all back into physical silver, and I'll just set on it. But that's the hedge, guys. So anyway, hope I didn't confuse you.